Well, welcome to today's podcast. Thanks for joining. I really appreciate you guys as audience members, and hopefully you're getting a lot out of these episodes and podcasts. And my goal is always to try to bring on interesting topics and certainly guests where I can find them. And so today is going to fit that mold to a T. I have a great guest, Clint Harris. He's a general partner at Nomad Capital. Play a whole bunch of different roles there, and I think primarily right now investor relations. But Nomad Capital, if you haven't come across them, they are focused on the self-storage syndication space, and I'm going to let Clint tell more about that. But I love what they're doing and kind of what they stand for, so I want to bring him and Nomad Capital to my audience. So Clint, thanks for joining me for the second time. I know the first time didn't work out quite as well, but thanks for joining me again.
Yeah, absolutely. Happy to be here. And honestly, you're right. We did this once before, and we had to redo it because of the audio. And frankly, I was looking forward to it. I had a great time the first time, and great to connect with you again. Thank you for being a guest on our podcast. I learned a lot about you, and because of that, I was looking forward to it. So happy to connect again.
That's great. That's great. Yeah, and I know this won't be the last time we're talking anyway. So I always look forward to these things. Probably, I'm going to personally learn more, and that's why I love doing these things. So, to kick things off, Clint, why don't you share a little bit more? I know we had some common paths actually in our background in terms of where our lives and where we invested and how's it land into self-storage? Like how'd that happen?
Yeah, that age-old tale of started with a career of implanting pacemakers and defibrillators, doing heart surgery, and then the natural flow that just turned into self-storage. We hear that story so many times. So I had a 16-year career as a medical sales rep in surgery, implanting devices, and that career comes with a lot of time being on call, nights and weekends. Heart problems are not Monday through Friday, 9 to 5. And so because of that, I kind of always knew that I was going to have to create an off-ramp from that lifestyle. My personal belief, by the way, I'm 42 years old, married with 2 young boys, live in Wilmington, North Carolina. And I'm looking at my generation, and I'm just kind of as a younger man, losing my faith in our ability for my generation to save our way to retirement in the same way that my parents and grandparents did. You used to be able to, work in the factory, and then you're retiring with the gold watch and the pension and the 401k and the Social Security and all that. And it's just not going to be the same. So I began my pursuit of what that off-ramp was going to look like. I decided real estate was the way that I was going to do that. I invested in a string of single-family homes. My wife and I had 9 single-family rentals. In 2017, I took a promotion. We moved to the beach in Wilmington, North Carolina, and I took over the medical sales territory there. That opened up the window because of the beach town that we live in. I started buying small multifamilies on a small island right off of Wilmington and converting those properties into Airbnb properties. So I would buy a small quadplex with bad long-term tenants that were month to month. Over time, I would move the tenants out, renovate the property, convert it to an Airbnb, and it would 3.5 to 4x the gross potential rental income. That lesson really kind of jumped out at me of an asset class conversion from one thing to the other and quadrupling the net operating income on the property. But I also realized around then, for the second time, that I'd done it wrong in terms of building a portfolio. I kind of realized this after the first time that I built up a small portfolio of single families. I realized this is a really slow way to get ahead. And I was doing the BRRRR strategy with limited success. I didn't really know what I was doing. And I realized, like, every time you refinance and you're pulling money back out of a property, you're really just cannibalizing your cash flow to get the money out, and you're going to cash flow, a couple $100 a month?
Right.
How many of those is it going to take that to affect your life in a meaningful way? So that's why I moved on to the Airbnb properties, which was very lucrative. The problem was I couldn't find a property management company that could operate my properties the way that I wanted them run. So we had to build a company around that. Took 2 years to build out Going Coastal Property Management that we still co-own with some partners. And it manages my 14 listings and then another 75. But it was right around the time that we were wrapping all that up. I've got amazing operating partners, and I'm silent partner at this point. But I realized that we did all that just focused on the cash flow and the and the financial side of things, because we're all chasing that quote unquote financial independence, right? The FIRE movement that's become popular. And frankly, by the time I replaced my income that I was making through cardiology, I realized that that is a really shallow goal. Just me personally speaking here, that's a shallow goal compared to what we really all want. That what we're really looking for is financial, time, and location independence combined, because those things create an independence of purpose. Like I replaced my income, but I still basically had my phone on me. I was on call, and I had to stay in this town where the properties were. And that's not what I'm going for. Like if what we really want is like 3 months on a catamaran with your family for vacation, or 3 months that you can spend with a family member that really needs you, or 3 months traveling and creating a sense of empathy and apathy for other humans with your kids, like whatever it may be, that freedom of purpose is going to look different for everybody, and that's fine. But that's what we're really looking for. So that's when I decided that short-term rentals and being burned out on guests was not the way. And from there, I made a switch into the self-storage industry, and then from there on into conversions, and that turned into Nomad Capital. But
Interesting.
I'll take a break there.
Yeah, no, that's great. No, it's amazing. You go, it doesn't, you don't have to look too far on social media, and somebody's saying, here's the financial freedom way to, own all this real estate. It's all passive income, and just as well as I do, that's active work, right? Right. I mean, it's hard, and especially if like you mentioned the property management, which I've experienced myself too, that they don't care as much about my property as much as I do. And
nobody's going to mind your business the way that you would mind your business. And the great property managers, I've found that they don't stay that way for long. Either if they're really good, they start getting really busy, or they start having a lot of success and having money and buying their own properties. And next thing you know, theirs take precedence over yours, or else they get burned out. Like 3-4 years is about as much as I've ever gotten out of a really good property manager. Unless they are confined to picking the right property, staying small, and being more of a boutique style.
Yeah.
Right? Otherwise, you just get, if you're making thin margins on more and more and more properties, people just get burned out.
Yeah, it's tough. But so a couple of things out of your story, which is great, and want to pull on some of those threads. One was the conversion, which is fascinating, right? Because you're trying to find the best use of that asset, right, to maximize the wealth. So that's huge, and I know that's we'll talk a little more about Nomad Capital itself, because I think that's a really interesting, creative way what you guys are doing. But I think the more important piece I think you hit on is the sort of broader purpose, right, of your life, right? Because you can chase all these sort of passive income greater than your burn rate. That sounds great, and it's a good thing, something to strive for. But what I don't think a lot of people think about is kind of what kind of life you're trying to build. Right? If you have that freedom, what do you want to do? Which is, sometimes you don't stop and think about and dream about that because you're just so busy, right? Working and striving.
What are we doing this for? Right? Like, what's the purpose? And personally, I've come to the point where I realize that I don't really care to die with a giant pile of stuff. I prefer to die with a big stack of pictures I did with people that I love in beautiful places. So that's my core values, and what my wife and I are trying to do with our family is like we want to create experiences that are lasting and meaningful. And the way that we do that is we have to have time and location independence, and then obviously the financial independence to be able to afford to do the things that we want to do. This is going to totally shock you. That asset class conversion topic comes up again in this story. Dun dun dun. Foreshadowing. Here's where we were at. Like, I was burned out in my cycle of the story, realizing I'd done everything for financial independence and left these other pieces of the puzzle out. So I started asking myself questions. Okay, looking around and identifying the successful, older, or more experienced real estate investors, the ones that clearly had the type of lifestyle that I was looking for, what are they doing and how did they get there, right? How do I fail faster using someone else's experience? So in looking around, I basically put together a panel of people that I looked up to, and it ultimately was three things when I was talking to them. It was hard money lending, and I didn't have the 7 figures it took to get started there, and the experience at the time to raise a fund from anybody else. It was mobile home parks. Keep in mind, I was burned out on tenants. Airbnbs have 8 to 10 tenants a month, and I had 14 of them and another 70 that our company was managing. I was like, that's not the way. It's a very, very active investing strategy. And the third way that I heard about was self-storage. And so I was like, okay, hold on a second. Let's unpack this. Self-storage, you're telling me there's no kitchens, there's no bathrooms, there's no one living in the property, and we're renting someone a box of air. I can do this. This is okay. This makes sense to me. I'm not a self-storage consumer, so I had trouble wrapping my head around that. There's some lessons you have to learn about humanity and our culture as a company, good, bad, or ugly. But the reality is, especially with the housing crisis, people aren't buying houses, they're renting. Renters use more storage. Young people are using storage and renting smaller places. There's all these compelling reasons why it's a good asset class. Well, remember that lesson I had learned previously by converting those small Airbnbs to short-term rentals. I'm an extrovert, and I very much believe in the power of people and relationships. And networking is important to me. And one of the things that I did is I listened to a lot of podcasts and books and things like that, but I also want to network locally and on a nationwide level, because I believe who I am and what we're going to accomplish is going to be a reflection of the places we go, the people we meet, and the content that we consume. Meeting my partners through local meetups, they're a father and son team, Eric and Levi Hemingway, that had a storage background, had started doing hotels, and we had projects next to each other and got to know each other over a period of a year or two. And they were getting back into storage and had done some conversion projects in the past. And they approached me with a Kmart building that they were interested in buying and converting to storage. And it slapped me across the face with, this is the same thing I'm already doing, right? I'm buying something at one valuation as one asset class. I'm converting it to a different asset class, which not only changes the gross potential rent coming in the case of storage, it also changes the formula by which the asset is valued. Like the first building we bought was an 87,000 square foot Kmart that had been empty for 10 years. We bought the building and the land for $1.5 million. If we wanted to build that replacement cinder block shell, it would have cost $6.5 million just to build it, plus the cost of the land, and it would have taken 2.5 to 3 years. So we bought that building for $1.5 million. We put $2.5 million into it. We're into it for $4 million. And as a stabilized self-storage facility, it's worth $9 million. And it's like, oh, this is real money. I get it. That asset class conversion, changing the formula by which the asset is valued, creates massive forced appreciation. The really unique thing about that is, yeah, it's money, but you can't eat equity. You've created so much value that it provides an opportunity for recapture, which means we could sell it, everybody gets a payday, we pay the taxes on it, and then we move on to the next one. And that's cool, but we're basically a glorified house flipper, and the day we stop working is the day we stop getting paid. So our model instead is we do a cash out refinance to around 60% loan to value, always fixed rate debt. We're able to pay out the investors and ourselves, plus another large chunk of capital on top. When it's coming by way of refinance, it's non-taxable because there's no capital gain. Just like if you bought your house for $200, pay it off, it appraises for $400 one day, you're going to go do a 75% loan to value refi, you pull out $300,000, non-taxable. Yes, you have a mortgage payment now, but you could take that money and scale and move on to something else if you wanted to. So same concept. It's the same Burr principle, the buy, rehab, renovate, rent, repeat strategy that people use for single family rentals. We're doing the same thing on a commercial level by changing it from an old nasty building that we're not buying on a cap rate. It's basically worth whatever somebody's willing to pay for it, and converting it to a building that the value is based upon the net operating income. We take a big old box, we chop it up into 600 or 700 little boxes, we rent it out, we recapitalize, and we move on. The buildings make sense. There was 2,000 Kmarts in the country at one point. They're all gone. But think about the residential density around a Kmart, the number of people in a 1, 3, 5, 7 mile radius, the visibility, the traffic count. It's obviously dependent on the storage in the area, the market, and everything else. But the long and short of it is that those people in that community used to drive to that big box retail building to buy their home goods. And even though Walmart and Amazon have decimated that space and they don't do that anymore, it still makes sense for those same people to drive back to the same building and sometimes pay us to put the same stuff right back inside. Right?
Yeah, it's funny. It's probably something that they bought it at Kmart at one point. Now they need a place to store it. Right?
When we were in Danville, Virginia, we've got, so it's 750 units in there, and they're a wire across the top. And part of the building has an upstairs balcony looking down. And I saw an old Kmart bag in one of the units. I was like, "You gotta be kidding me!" Like, there's no way. I wonder if it came from this one. So that's the model. From there, we did that first Kmart, then we did another, then another, then another, then another. I left my job in medical sales in 2022, full-time commercial real estate investor. I'm one of the 4 general partners with Nomad. Then we have 16 employees. We currently have 150 million in assets under management. We're on the way to try to get to 500 million in 5 years and $1 billion in 10 by converting these old buildings. And you can already tell, and so can your listeners by now, that I talk too much. But let me take this one step further because of something you said earlier. And it's the purpose. It's the why. And it's in the name Nomad. And I want to tell a quick story about our core values and the belief system. My partner, Eric Hemingway, was a home builder. And then in 2006, he built his first self-storage facility from the ground up. Then the market crashed in '08, and all buildings stopped. And so Eric and his wife, Rachel, and their 5 kids ended up buying a 36-foot catamaran sailboat in Greece, sight unseen. And they said, "Hey, we're going to go sailing for 6 months until this economy thing turns around," which we all know took a lot longer than that. They ended up sailing for 6 months. The economy was not turned around. They found out they were pregnant, actually stopped and had their 6th kid in Jerusalem, continued sailing for a total of 3.5 years, eventually sailed across the Mediterranean, and then sailed across the Atlantic Ocean and landed back in Wilmington, North Carolina, where we are here. Then they started building again, started doing storage again, started doing conversions, hotels, and then went all in on storage. And we've been doing full speed conversions ever since. That boat trip is the idea that eventually turned into Nomad Capital, right? It's an opportunity to have freedom of purpose, where you have a portfolio of commercial assets that are providing the financial time and location independence that you can decide what your independence of purpose looks like, whether it's laying on a beach and getting fat, or mission work or charity work, or raising your kids, or being there for family, or just travel and exploration. Whatever that looks like for you, it is going to be an option only if you found a pathway for that financial time and location independence. So that's the idea that sparked Nomad. That's the reason behind the name Nomad. And our purpose is to build a tribe of real estate nomads that have broken the cycle of trading time for money to pay for somebody else's days off. And the way that we do that is we have to have the forced appreciation in our asset class that we can recapture by refi, instead of having to sell the properties and basically just be a glorified house flipper.
Right. Yeah, which is typically the model. And then, and again, there's always potential case where makes sense to sell, but that's not the core, sounds like, your model, right? You want to hold on to these and continue to cash flow them, right? And obviously, because it's probably lower maintenance in terms of managing the properties, because there's no tenant, like people living in them. I mean, there's obviously people who take the space at turnover, but they stop paying. You just shut them out, and you kind of move their stuff out, and you find someone else.
Yeah, it doesn't happen often, especially since we are exclusively doing climate-controlled storage. It's a little bit more expensive. It's a nicer clientele. These are items they care about. So there's not as much turnover. When you do, it is pretty much an automated system. But these are typically lifestyle items that people really care about. So that's a fairly low delinquency rate. But yeah, you're exactly right. In terms of the management, let's be honest for a second. There's nothing sexy about self-storage. Like, it's fine. It's a great asset class. I'm not knocking it, but like, you're renting someone a box of air. There's nothing sexy about that. What is sexy about it is the business model where we are doing it without having to build these up and then sell them.
Yeah.
Right? By converting an old big box retail building, that opens up all these other possibilities. And that's what we get excited about, right? That's why we're excited about our core investor base, because we're creating opportunities for people to change the amount of time that they get to spend with their kids or with their grandkids, which potentially has time to change what kind of character that person has and what they think a normal relationship with their kids look like.
Yeah.
Right. So it's, believe it or not, it is bigger, at least for me and my partners and for our company and for our investors, it is bigger than just self-storage.
Yeah, and that's it. I mean, we get, and before we even start recording, I mean, I get often asked these sorts of questions, where should I invest? And, but they're not really thinking about that bigger purpose around it. They're just saying, hey, let me find the thing that has the best return or something, whatever they're looking for, without really thinking through kind of what that does for them, or why would they invest, right? And how much activity it will require, right, to actually maintain it. And I think people ideally would like something more passive, right? And that's why they probably maybe put it into the stock market and just kind of let it ride, right? It's easier, right? I don't have to think about it, right? And that's why real estate can be difficult for people to get in, because I keep on telling them it is active, right? If you're trying to own property and manage it, right? As we talked about. But, teaming up with trusted partner, that's why meeting you and your team to understand how they operate, do your values align, and why you do this, I think will give people peace of mind they can actually be more passive, right, in this situation.
Yeah, it's so important. So many people fall in the trap of just looking at the deal. And a lot of times it's so much more important to look at who are you partnered with? What are the core values? What are the beliefs? Is it a good fit? And then what's the asset class? But all of that should be a reflection as to how it fits in with your personal goals and strategy.
Yeah.
And if you're looking for, this is something else, like if you're looking for a really long-term hold, you better make sure it's an asset class that's great for a long-term hold, right? If you're looking for a long-term hold, you better make sure it's an asset class that isn't going to be under threat with overdevelopment in the future. One of the things we like about storage is, like an apartment complex, of all the money coming in, the net, operating income coming in, 60 to 70% of that can be expenses. Your security, your landscaping, your office staff, your maintenance, your everybody else. With storage, it's of all the money coming in, when we open up a new facility, about 30% is the expense ratio. That's the money we're spending on pest control, people sweeping up, on-site staff, the security system, lights, the air conditioning and heat, and then like promotions, like buy 1 month, get one free, half off the first few months, right? That's when we open up a new facility. After it's full, that expense ratio drops down to like 21 to 24%, right? You stop the promotions, it's full. If somebody moves out and you're going to increase the price, and somebody else is going to move in without having to do a massive marketing campaign. So something that over time just kind of becomes more and more stable. The expense ratio comes down. It creates some very unique liquidity options, and highly inflation resistant, that you're able to adjust those prices on a month-to-month basis. The only more inflation-resistant asset class in the commercial asset space is literally hotels, because it's a night-to-night rate change.
Right, some flexibility. And it's, when you look at, what at the time of this recording, I mean, who knows, with the assets seem a little inflated broadly. I mean, I have people who are looking to buy homes and they can't afford them because the prices on them are crazy. So they're kind of moving in together or maintaining, renting in smaller spaces because they can't afford it, right? And people or they're combining families into, a smaller place. So that probably means if I want my stuff, I have to store them somewhere, right? Am I kind of, are you seeing that happen in the markets you guys are operating?
Yeah, there's a big generational shift. There's a couple things. The first big bump that we saw was COVID. And that was all of a sudden everyone's location independent and could work from home. And so all of a sudden everybody needs to take that third bedroom and turn it into an office. So let's move out the bedroom furniture, let's get storage. So storage was huge because of that. We had unbelievably low interest rates for a period of time, and the housing market exploded. Storage did very well during that. At Nomad Capital, we never use variable rate debt. And so that interest rate shooting up higher and faster than they ever have didn't affect our projects, but it definitely had a nationwide impact on storage because the housing market effectively got frozen. You had interest rates shot up super fast, and everybody had just come through the prices shooting up from having really low interest rates right before that. So the housing market basically froze, and you had people that even if they wanted to downsize and sell a $700,000 house and move into a $450,000 house, a lot of those people would have still ended up with a higher mortgage payment than they currently had. You had 70% of the country locked into their current house with an interest rate below 5%. So those people can't really sell, because even if they buy something else for less money, their payment's going to be more because the interest rates are higher. So the drivers for storage are death, divorce, downsizing, and displacement, right? Moving. Now, obviously, death and divorce are still happening, but you're right. A lot of people are now renting. In fact, for the next 3 to 4 years, I think the cost of renting is less than the cost of owning right now. One of the things that we're seeing is you do have families consolidating and multi-generational people moving together. The younger generation is unable to buy houses the way the previous generation did. They're renting. When you're renting based upon the square footage that you get. So a lot of times, instead of renting a 2-bedroom condo for $1,800 a month, we may see them rent a 1-bedroom for $1,300 a month, and then get a storage unit for $150 a month, right? But the interesting thing is when you think of storage, and this is just kind of anecdotal for your listener base, when you think of storage, you think of like baby boomers, heirlooms, Christmas decorations, and they're in once or twice a year. Low-slung metal buildings, non-climate controlled. That's not what we're doing, because that's not what we're seeing. The millennial population right now is the largest population segment in the country. They are 34% of the population. They are using 38% of storage. And the way that they're using it is completely different than what you're used to. These people are in and out of the property on average more than 3 times a month. And they are using it as an extension of the closet and extension of the garage. Instead of paying for that extra bedroom, they're going to have a storage unit that they can pop into on a Saturday morning and get their fill in the blank. Mountain bike, fly rods, waders, scuba gear, snowboard, wakeboard, whatever it may be, and grab their snow bibs and get out of town. So these consumers need to be able to have access to this property at 6 a.m. on a Saturday morning with a QR code on the door, a touchscreen kiosk, through their phone, whatever it may be. So if you are doing storage these days, it needs to be several things. It needs to be safe, secure, well-lit, easy access, centrally located, and it has to be climate controlled. And for us, the model is, instead of spending $120 a square foot for construction in 3 years to build one, after we find the 7 acres to put it on the outside of town, we're going to grab the old textile mill right in the middle of downtown, convert it in 10 to 12 months and do it for half the cost of construction. And even by the time a competitor can come into the market, we're done and full.
Crazy. Yeah, and I see it too. To your point, as I think about it, just these days, I live in a place where there's people with like massive mansions, and I think there's going to be in my mind, a sort of shift to say, hey, maybe I need a smaller footprint in my space because I want to be able to travel. I want to have more flexibility, and I can't even afford some of these things anyway. So self-storage for my things are a good spot, right? I don't have to pay property tax on that thing. I don't have to, get insurance on it. You guys are doing that, right? So it's a nice alternative to store stuff that maybe I don't need on a daily basis.
It is. On a personal level, I think we as a society should look at our consumerism, which flies in the face of the investment strategy that I have. But one thing this is just a funny story. I did a guest speaking spot on a webinar. It's probably been 6 months now. And it was for Shanghai, China. It was for an investment group that is based in the U.S., but they raise capital for U.S. investments from China, from an investor base. So I signed up to do this 1-hour webinar, not realizing that it was going to turn into 2.5 hours, because it was 1 hour for me, but there's a translator right there. So I'm speaking, they're speaking, whatever. And there was 900 people on this call. And I did the whole thing. And it was laborious, but it was fun. I enjoyed it, and I like people, whatever. Once we got to the Q&A section, I had a couple legitimate questions, but 40 minutes of the questions were disbelief that this was a real thing. There's no way. These people are living in China, and they're like, Shanghai is the most densely populated country or city in the world, and we've never heard of storage. You're telling me that Americans own a house, fill their house with stuff, keep buying more stuff, and then go rent a place to put more stuff? And I was like, yes. And they're like, why don't they get rid of stuff? I'm like, I get it. Well, there's not enough time. And then they're like, well, hold on. Are you saying, and they just kept asking the same question over and over. And it was a cultural thing that it was not about the asset, the investment at all. It was like, I don't understand this even a little bit, to the point of continuing to ask the same question for 40 minutes. And I left that call just being like, we're dumb. Like, as a society, like, we're not, we come from so much privilege and we're so spoiled. And there's this emotional attachment to things that, frankly, I don't really want in my life. So there's two sides of that coin, right? There's who I'm trying to be and the way I'm trying to raise my kids. And then there's recognize opportunity and also understanding that it is providing a service to those people that can't afford a big enough house to keep things that are important to them, right? So it's a funny balance, but it's where we are as a country.
Yeah, listen, you can't, and human behavior is human behavior, right? You can only control so much of yourself, right? That's the reality of it. We are a consumer-based economy. There's absolutely no doubt about it, and the toys and things we have, our luxuries, in a lot of people's minds are necessities now, right? That's what happens, right? And you're just, catering to kind of the situation and helping them out in that way. So it is funny to hear kind of the different sort of cultural thinking around that, because, I kind of feel on that side, it's like, if I buy something, someone else has got to go, right? Because that's the way I operate. But, it probably isn't mainstream.
Clearly not. But if you get it down to the core value and you just look past the self-storage thing, like, anytime you can look at any commercial asset and you find an operator that can do it for half the cost of new development, you should probably take a look. Now, that doesn't mean it aligns with your thesis and your core values of what you're trying to accomplish for your family. But ultimately, that's what it comes down to. You're identifying a need in the market. You're looking for opportunity to get in at a lower cost basis, right? The reason that we have value in our self-storage facilities is the same reason there's value in a house that you flip. You're not making your money when you sell it. You're not making your money when you're renovating it. You made your money when it smelled like dogs and cats and you bought it for dirt cheap, right? Yeah. We want the dog and cat properties. We want the hole in the roof, the homeless people living inside of it. We want the rats, the fleas, everything else. We want it sitting empty for 12 years with the leak in the roof. We want the ugly duckling, right? Because we can turn that into a golden goose. So it's really all about that cost basis and getting that initial project at the lowest cost that we can, that my guys in the group that are actually doing the real work. I just talk to investors all day, and I love it. That's not work. That's fun. I was doing this for fun before I started getting paid for it. They're actually swinging the hammers and doing the hard work, right? So they're getting in there at a low-cost basis.
Yeah, so on that note, too, maybe we could talk a little bit about it from you guys have a fund or how it's structured, but, what's a good fit for folks in terms of investment profile? Because this is definitely, even your podcast, truly passive income. Should be a passive sort of activity. What's it look like for an investor? Who's this a good fit for?
Sure, and that is the funny thing about that name, is that there really is no truly passive, and right, that's the thing. It's on a scale. One passive thing in the world, it's going to be really passive, but even then, even within syndication, you still have to pick the right operators. You should do the due diligence of vetting the people in the deal. After you've done that the first time, then yes, hopefully you have a relationship and things get progressively easier and more passive, but I'll be the first to point out that was probably not the best name in the world. And then we poke fun at each other and ourselves about that. So there's that side of things. The way that it looks is we raise capital from a group of investors. Most of our original investors were the physicians that I used to work with. A lot of the surgeons, cardiologists, electrophysiologists, and interventionalists that I used to work with are early investors in our deals. But it's basically, syndication is just where a group of people take on a project larger than what any individual could do on their own. And the whole is greater than the sum of its parts. So we do have in the past, we've done 2 Kmarts, 3 warehouses, 2 textile mills, a grocery store, and an old soda bottling facility. Right now we're doing a boot factory and a carpet factory. We're converting all those projects. Now, we do currently have a fund offering available. I'm just about wrapped up with a $10 million fund that is for the purchase of $30 million worth of projects that are going to be converted to about $70 to $80 million worth of storage. We've already closed on the first 3 projects. The first one is completed and is open and is currently leasing units. The second has about 5 months to go. The third has about 8 months to go. The fourth we have not closed on that property yet. It's under contract. So one investment into a fund gives ownership across 4 different self-storage facilities across the Southeast, different operators, different local market drivers. So a lot of people love that because it creates that level of diversity. Our model traditionally is that we build these properties up, stabilize them, and then we're going to do a cash out refinance at or before 5 years. Everybody gets their money back plus another big chunk, doing the best we can to try to double everybody's money tax-free in 5 years or less. Beyond that, everybody stays in. We hold it long-term, and it continues to cash flow. I'll be the first to admit, these are development deals, and we are developers. Any goal that you set for yourself in terms of financial strategy that you want to employ, you can find somebody out there doing it. ATMs, mobile home parks, car washes, vineyards, multifamily, whatever it may be. So I don't encourage people to look at us and what we're doing. And if you think it's cool, you should invest with us. No, you should talk to your spouse, your partner. You should decide what's important for your family and then look for something that fits. With us, from the day an investor puts money into a deal, they start earning a return. But if you think about an individual project, that building is not cash flowing. It's going to take us a year to build it out. When we're done with that build out, it's worth a lot more than when we started, but it's empty. So now we got to fill it up. The good news is our break-even occupancy is around 40%. Most self-storage is more like 60 to 65%. But it's going to take us 18 to 24 months to fill that property up to the point of being cash flow positive. So if you're looking for day one cash flow or monthly paycheck, or you're trying to put money into something that's going to get you out of a job that you don't like, my recommendation is we're probably not the guys. You probably don't want to do that. So it just comes down to what your goal is. So for us, you're going to get a little bit higher return, but it's going to take some patience. We have to do the development deal. We have to fill it up. So at the end of the day, if someone's disgruntled and doesn't like what we're doing, I know that 2, 3, 4 years from now, I'm going to have to be the one that takes the phone call anyway. So we just try to be really upfront, transparent about what we're doing and identify the right investors, because we want to be in business for a very long time, right? And if your immediate need is you're looking for cash flow to get you out of a situation you don't like, we're probably not the guys. But if you are patient and you think self-storage is a good asset that you may want to have in your portfolio and it can create some diversity for you, I would think you should probably take a look at it, because it's half the cost of new development, but it's not going to cash flow as fast. It's going to take some patience.
Yeah, no, that's really key, and I really appreciate you sharing, that sort of nuance to it, because people could get so fixated on a rate of return or X times their investment and kind of not take the full picture into account. And that's why it's so key is that, people ask me that question, right? Where to invest? And you got to take the full picture. And what is this for? Right? Yeah. To your point, do I need cash flow immediately to kind of supplement my, or replace my income? Or, hey, I do want to get into the space and I'm patient. I'm okay. This is a long-term thing. Maybe it's in my self-directed IRA. Who knows? Right? Can't even touch it anyway. So, you got to kind of fit that into your broader sort of investment philosophy and kind of what you're trying to shape for your life, right? Absolutely. Like we went back to purpose. So, and this is why, talking to folks like Clint will help you sort of figure that out and determine if it's a good fit or not. So Clint, like if someone is interested, I know you guys are wrapping up fund maybe in the future, what's the best way for them to sort of gauge you guys and find out more?
Yeah, the best way is straight through the website. It's Nomad Capital US. You can schedule a call there. It'll come straight to me. You can see access to our investor portal, everything else we have going on. But nomadcapital.us is the best way. We do know that our job is always to listen to the market. We do have our first project lined up after this fund. It's going to be the first one that's likely designated as a 5-year hold, because the economics on this unique property don't make it great for a long-term hold. Mm-hmm. So it's going to be a shorter, a little bit more traditional project than that investors are used to seeing. Same return profile, but it'll be a liquidation and then move on to another thing. So we don't want to get stuck in the pigeonholed into this is what we do. We execute the same exit every time. We have 3 to 4 exit strategies. Our model is we have our plan that we set up, but at the end of the day, we like to say that we can't change the wind, but we can adjust our sails, right? It's a nod to Eric and his years of sailing, but it's not It's not our option to, force the market into what we want it to do. It's we have to be nimble. One of the ways that we do that is through the vertical integration of we are the acquisition team, we are the construction team, we are the property management team. Control the risks that we can control. But yeah, if you want to hear about what we're doing, what we're up to, the best way is through that website, nomadcapital.us.
That's great. Yeah, and I love that. That's probably a great way to end this in terms of control. Control the controllable. So we hear that sort of term, right? And for you as listeners, you control your own fate of life, right? I believe that, and you can take ownership of it to invest in things that fit your model and your philosophy, and partner with the right types of people. So Clint, I really appreciate you coming back for round 2 of this. In dealing with me, I really appreciate you kind of sharing your wisdom and thoughts in Nomad Capital. And I really wish you guys much success as we head ahead into 2025 and beyond. So any last parting shots on your end?
No, man, I just tell you, thank you so much. I appreciate what you're doing. I know that you've turned yourself into a lightning rod for great conversation. So thank you so much. And I look forward to talking to you next year, which is in less than 2 weeks. So let's stay connected, look for ways that we can help each other. At the end of the day, it's a fairly small industry in a small space. I've certainly benefited from a lot of the information that you've shared with us and knowledge you gave us on your interview. So thanks for that. And besides that, I'll just say, I'm happy to help with anything that I can, even if that's short-term rentals, Airbnb, small multifamilies, conversions, anything like that. I'm a people person, and I believe in relationships. So if there's any way I can help you or anyone else, feel free to reach out.
I appreciate it, Clint, and we'll definitely be chatting with you in the future. And thanks again for joining.
Thanks for joining me on this episode today. I really am grateful for you as listeners to the Millennial Pride podcast. I hope you're getting some tremendous value out of it, and hopefully pushing you along your journey to financial freedom. I put this podcast together really to help you get more educated around your finances so that you feel empowered to live the life that you really want. And if you like the content that you heard today or watched, then I would encourage you to go to my website, perennialpride.com. There's tons of other content there. And you can access my book, Wealth Beyond the Numbers. You can buy it there on my website. It's a aggregation of a lot of great tips and tools I've learned to not only build my wealth in my accounts, but build wealth in my life and abundance and joy, and something that has a lot of my experiences in the journey that I've been on personally. Hopefully that can be also of value to you as you sort of move forward. So thanks again for being a Perennial Pride listener, and we'll see you on the next episode.